Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3. This is Section E. This is a remembering and understanding topic. Recall assumptions like the highest and best use, market participant assumptions, and unit of account, and approaches like the cost, income, and market approach used to measure fair value. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training where we go over the key ingredients to passing the CPA exam. Again, it's 1 hour, it is free, and we will show you how to pass the CPA exam without wasting months or even years of your time and wasting a ton of money as well. So make sure you go check that out. And another thing that you should check out is also becoming a SuperfastCPA Pro member. In today's video, we are only going to be going over 5 questions, but SuperfastCPA Pro members get access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a SuperfastCPA Pro member. So again, make sure you check out the webinar, make sure you check out becoming a SuperfastCPA Pro member. With all that, let's dive straight into the questions. All right, here we are at question 1. And something that I'll say about this video is these concepts aren't extremely difficult, but there's a few different ones. So that's why I'm making this video, because I'm kind of trying to put a whole bunch of different things about fair value measurement into this one video. So let's dive in. This is a pretty straightforward one. Which of the following is not an approach used to measure fair value? So of these 4, 3 of them are used to measure fair value and 1 is not. If you are paying attention to the intro, you already know the answer. If you want, go ahead and pause the video and think about it. But if not, that's okay. We're going to look at the answer to learn how to measure fair value with each of these different approaches. All right, here we are. The answer is D. Historical cost approach is the one that is not a measure of fair value. That's not one of the approaches. So let's dive into this. This is a pretty simple concept, and I don't think it's one that you would be heavily tested on. So we're just going to have one question on it here. And to start off, let's talk about what fair value even is. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So that is the definition of fair value. That's something that you might need to know. And let's talk about the different approaches to measuring fair value. There's the market approach. This uses prices and information from market transactions for identical or comparable assets and liabilities. So this is probably the most common one that you might think about. This is literally just comparing it to the market and seeing what the fair value is based off of the other things that are in the market. There's the income approach. This converts future amounts like cash flows to present value using discount rates. And the cost approach. This reflects the amount needed to replace the asset adjusted for depreciation or obsolescence. So those are the 3 ways that you can measure fair value: market approach, income approach, cost approach. And that's pretty much what you need to know as far as I can tell. So you just need to know those are the 3 approaches and basically what the differences are between them. The historical cost approach obviously is not a fair value approach. Historical cost refers to the original purchase price of an asset and does not reflect current market conditions or fair value. So this is like the first question just to kind of give us an idea of what fair value even is and what are the typical approaches to measuring it. Now let's go to the next questions to learn about different things when it comes to fair value. All right, here we are at question 2. And now that we're at a question that's like this, I want to point out something that I always like to point out. I couldn't do it for the first question, but always read the last part of the question first. I typically bold it in my videos, but it's not going to be like that for the exam. But it's to kind of give you an idea of what you should be looking for. You always want to read the last part of the question first, because that is the part of the question that typically is like the real question. It's what you really need to do and what you really need to figure out. And reading this last part first will give you context as you read through the rest of the question for what you're looking for and what you're supposed to be doing. So let's read this. What is the fair value of the land? So we know we're dealing with fair value. That would be helpful on test day. Let's go up to the top. A company owns a vacant piece of land in a growing commercial area. The land has the following potential uses. Residential use, and that would have a current value of $500,000 if they used it for residential use. There's commercial use, where the land would have a current value of $800,000, but it would require $100,000 of development costs. And then it could also be used for agricultural use, and that would have a value of $450,000, and there's no extra costs. So out of all this, what is the fair value of the land? How do we use this information to figure out the fair value of the land? Now, if you have no idea how this works, that's okay. We're going to look at it together. I feel like just kind of based off of basic intuition, you could probably figure out the correct answer. But again, if you don't want to try or if you don't know, that's okay. We're going to look at the answer together. All right, here we are. The answer is C, $700,000. That is going to be the fair value of this land. And we're going to talk about what this even is. This is a concept called the highest and best use concept. So let's walk through this. The highest and best use concept determines the use of a non-financial asset. That's important. This is only for non-financial assets. Highest and best use is for non-financial assets, such as land and buildings and things like that, that maximizes its value, considering what is physically possible, legally permissible, and financially feasible. So with that, the fair value reflects the net value after accounting for costs to achieve that use. So we figure out what the best value is out of these, and it's pretty easy to figure out. The residential use, that's $500,000. Commercial use, that was $800,000, but you subtract $100,000 to get to $700,000 because you do have to spend that $100,000 for it to be used. And then there's the agricultural use, $450,000. Out of those, it's pretty clear that the best use would be the $700,000 because that has the biggest or the best current value out of these three. So the highest net value is $700,000. So that is going to be the fair value of the land determined using the highest and best use. So again, if you have a situation where there's a non-financial asset and there's multiple different uses for it and you're not sure which one to take, you do this approach where you figure out which one would give you the best value, and that is going to be the fair value of that non-financial asset. So with that, we learned another concept about fair value. Now let's go to the next question. All right, here we are at question 3. What is the fair value of the machine? Okay, let's go up to the top. A company owns a specialized machine that can be sold in 2 different markets. There is no principal market for the machine. The details for each market are as follows. So in the Chicago market, the selling price would be $150,000 and the transaction costs are $10,000. Denver market would be a selling price of $140,000 and the transaction costs are $3,000. So what is the fair value of the machine? This is a little bit different than the previous question, so don't think that this is highest and best use necessarily, but if you have any idea how to do this, that's great. If not, let's go ahead and look at the answer together. All right, here we are. The answer is D, $150,000. So this is another concept that we need to learn. This is called the most advantageous market concept. So let's walk through this. The most advantageous market is used to determine fair value when there is no principal market for an asset or a liability. So if there's no market that this should be used in, and rather there's multiple different markets that you could buy the asset or sell the liability in, you need to pick the most advantageous one. So let's walk through how to figure that out. It is the market that provides the highest net proceeds, that would be the selling price minus the transaction costs, or the lowest net cost to transfer a liability. So again, it's what gives you the best money in the end. However, while transaction costs are used to identify the most advantageous market, they are not included in the fair value measurement itself. The fair value is based on the selling price in the most advantageous market. So that might sound a little bit more complicated than it is. What you really do is you figure out the net proceeds for each of them. Whichever one has the highest net proceeds, that is the most advantageous market. And then you don't use that net proceeds number for the fair market value. You actually just use the selling price. So you can see that right here. The net proceeds for the Chicago market is $140,000 because it's $150 less $10,000. The Denver market has net proceeds of $140,000 less $3,000, so it's $137,000. So obviously $140,000 is better. So Chicago is the most advantageous market, but we don't use this $140,000 as the fair value. Instead, we now use the selling price of the most advantageous market as the fair value. So even though we found out that the most advantageous market is Chicago by doing this calculation, we still use the selling price of the most advantageous market, Chicago, as the fair value. So $150,000 is the actual fair value. So again, not as complicated as it might seem. You just figure out which has the best net proceeds. That's the most advantageous market. And then you use the selling price from that market, and that is the fair market value for the asset that you're dealing with. And again, this is specifically when you have no principal market for that asset. You have multiple markets that you could be dealing with. All right, now let's go to the next question. All right, here we are at question 4. What is the fair value of the machine? Let's go up to the top. A company is selling a specialized production machine and has identified 3 potential markets. There is no principal market, and the company only has estimates for the net proceeds and the transaction costs for each market as follows. Market 1 has net proceeds of $290,000, which with transaction costs of $12,000. Market 2 has net proceeds of $285,000 with transaction costs of $15,000, and Market 3 has net proceeds of $275,000 with transaction costs of $5,000. So what is the fair value of this machine? Now, we just went over this in question 3, but it's in a little bit of a different format. If you pay attention, you should be able to figure out the answer to this one pretty easily. So pause the video, think through this, if you don't already know the answer, and when you're ready, come back, we will look at the answer together. All right, here we are. The answer is D, $302,000. That's going to be the fair market value for this transaction or for this asset. And again, it's pretty easy once you realize that you're already given the answer pretty much. To determine the fair value when there is no principal market, the company identifies the most advantageous market as the one with the highest net proceeds. We were already given the net proceeds for each of them. So before we even do anything, we easily can know that market 1 is the most advantageous market because it has a net proceeds of $290,000 compared to market 2's $285,000 and market 3's $275,000. So we don't even need to do anything with market 2 or market 3 because we know they have less net proceeds, so they are not the most advantageous. So we just go back up to market 1, figure that the net proceeds is after the transaction costs. So we add back the transaction costs to get the selling price, and that is the fair market value in this situation. The market with the highest net proceeds is the one that you use. But again, remember, the fair value is actually the selling price in that market. So don't forget that. Pretty easy concept. Now let's go to the next question. All right, here we are at question 5. Let's read the last part. Which of the following is considered a market participant? Okay, so this is something we haven't talked about yet. A company is measuring the fair value of a specialized piece of equipment. To determine fair value, the company must consider market participants. Which of the following is considered a market participant? So out of all these different options, what is a market participant? And this is kind of the underlying thing throughout all of the things that we've been dealing with. Market participants are the ones that are doing all of these fair value transactions typically. So what is a market participant? If you know, or if you have a guess, pause the video, kind of read through these and think about it yourself. And when you're ready, come back. We will look at the answer together. All right, the answer is C, an independent buyer who is willing, able, and knowledgeable about the asset. That is a market participant. So let's read through this. Again, a market participant is defined as a party that is independent of the entity selling the asset, so it can't be a related party, is knowledgeable about the asset or the liability, so they don't really count if they have no idea what they're doing or no idea what they're buying or selling. They need to be knowledgeable and know what they are doing. They're willing and are able to transact for the asset or the liability. So again, not only do they know about it and they're knowledgeable about it, but they want to be doing this transaction. And finally, the act is in their economic best interest. So a market participant is somebody who is independent, knows about the asset, they want to be doing this transaction, and they're doing it for their best interest. So that's why we were talking about the highest and best use concept previously, because a market participant should be looking for something or using something in their best economic interest. So that's why we have the highest and best use. So let's read through the different options just to show you why they are wrong. Option A is incorrect because market participants are assumed to be knowledgeable, whereas A said that they didn't really have any knowledge of the condition or the value. Option B is incorrect because related parties do not meet the definition. It has to be an independent individual or independent entity. They can't be a related party. Option D is incorrect because the current owner of the asset is not considered a market participant. So again, you can't really be a market participant with yourself. If you're going to keep the asset for yourself, that's not really putting it out on the market. So, kind of defeats the purpose of being a market participant. So that leaves answer C as the correct one because again, they are independent, willing, able, and knowledgeable to do the transaction. And with that, we've gone over a lot in just 5 questions. We've gone over multiple different concepts. And before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 3, 4, 5 questions trying to teach you how to calculate fair value using the most advantageous market approach or whatever the case may be. These are the things that keep popping up, so you write them in your own words, kind of as a summary of the most important things that you learned. And as you do this each day after going through the questions, you will be building your own personal repository of what is most important for the exam in your own words. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's go ahead and just read through. First off, just a reminder, what is fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants. We talked about market participants just barely at the measurement date. And there are multiple different approaches to this. There's 3 approaches, and you basically just need to know the names of the 3 approaches and generally what they do. The 3 approaches to measure fair value are the market approach, and that would be based off of market price. It's kind of easy to think about that one. The income approach, which is including discounted cash flows, and then there's the cost approach, and that would be the replacement costs. How much does it cost to replace this item, or including depreciation and obsolescence? So those are the 3 valuation approaches. Now let's talk about the highest and best use concept. The highest and best use of a non-financial asset is the use that maximizes its value, considering what is physically possible, legally permissible, and financially feasible. So as long as you can actually legally do it, the asset can physically do what you want it to do, and you actually have the money to do it, then whatever is going to give you the most bang for your buck for a non-financial asset, then that is the highest and best use, and that is the fair value of that non-financial asset. Now let's talk about market participants again. Market participants are independent, knowledgeable, and willing buyers and sellers acting in their economic best interest in the principal or most advantageous market. So market participants should be acting in their own best interest, and they know what they're doing, supposedly, we're assuming that. And speaking of most advantageous market, When no principal market exists, the most advantageous market is the one that provides the highest net proceeds or lowest net cost if you were doing a liability, though transaction costs are excluded from the fair value measurement. So one more reminder, when you figure out the most advantageous market, you're taking away the transaction costs to see the best net proceeds. But once you know the best net proceeds, meaning the best market, then you use the selling price in that market as the fair value for the item that you're dealing with. And those were the pillar topics for this video. I know we went over a lot of different things, and with that, that is the end of this video. I hope this was helpful. Make sure you check out becoming a Superfast CPA Pro member on SuperfastCPA.com. One of the easiest ways to do that is by first signing up for our Superfast CPA training webinar. It's only 1 hour, it's free, and we will teach you the key ingredients to passing the CPA exam. And after you watch that, you're going to want to learn more, so that's why you become a Superfast CPA Pro member, because Superfast CPA Pro members not only get access to the Pro course, where Nate explains in detail exactly what you're supposed to be doing every single day of your study process, but also Superfast CPA Pro members get access to the full 10-question versions of these videos, so they get another 5 questions that they get to practice with me in the Superfast CPA Pro forum. So make sure you check out the webinar, check out becoming a Pro member. Again, I hope this was helpful. If you liked the video, make sure to like it and leave a comment, and I will see you in the next video.